today is a very crucial day in US trade. So today and tomorrow is something that we'll be watching out for from the US market perspective, and what kind of impact does it have on local equities.
Sure, I think we also have a guest joining in today, Sunil Subramaniam, market expert. Sunil, great to have you on the show. A bolt from the blue, so to say, when it comes to what the Fed really said. But do you think, the dot plot of 2 rate cuts next year, does it come as a big disappointment? Because, markets knew that we could see slower rate cuts going forward. Do you think that this is something in hindsight that the market just got a confirmation of? Or do you think this is a fresh trigger and we could see US markets in fact head lower from where we are now?
So I think that the markets got the trend right, that they didn't get the depth of the trend right? That US economy was recovering well and that inflation was rising. I think the Dow and the FII flows into India generally have been looking at this from a perspective that the rate cut scenario is going to alter. What they didn't expect was that a sticky inflation above the Fed's 2% expectation all the way down to 2026. And you're mentioning the dot plot saying 2 next year. I'm saying that actually the Fed governor did not even specify that, right? He said wait and watch. So I think the market is reading it as 2. Originally, just 4 months back, I think it was 4 rate cut, then it became 3. Now its market is reading 2. But my own sense is the Fed governor, this is what is called as a hawkish cut. It's a oxymoron, a word, to that extent. So having a hawkish cut, which means that he's unwilling to commit on anything for the future. And that's what I think created a nervousness for the markets, because while recovery of the economy is good news, the issue is that liquidity, always they like rate cuts from an equity as a risky asset perspective. So the moment the rate cut scenario was not as predicted, a lot of that liquidity would reverse. You would probably see money going from equity into debt, because now you have excellent 4.5% yield from the US Treasury on a risk-free basis. So I think what surprised the market was the extent of this rather than the trend. So that's what the reaction was today. I think the second aspect is also, remember that we are heading to the holiday season. So a lot of people probably who would have looked at a correction and said I could buy, they are in a holiday mode. So I think that's the lack of buying support also led to kind of a slightly a free fall both in the US markets and in India.
Sunil, obviously you have been working for years and decades in the mutual fund industry, and now given the fact that the inflows are moderating, do you think domestic investors with the FII selling are losing the edge, or you think probably the domestic inflows still remain robust so that we can cover up whatever FIIs are selling? Clearly with the IPOs coming in, with a lot of QIPs coming in, do you think the primary market action and the pipe deals are something that now mutual fund managers will have to choose versus listed equities?
Not necessarily. I'll tell you where and first of all, you mentioned moderating flows. I think to look at from a 45,000 to come to 36,000 in a time when for 2 continuous months the market has corrected. So I would look at it as saying it's resilient. That there's been not much of change. The SIP book remained constant. So I would say the resilience of the domestic investor is coming through, and he's still supporting the thing. The margin 45 becoming 35, it's only a reallocation. Large cap dropped because there was correction. So I would say that domestic fund managers, in fact, are still sitting on a lot of cash. What is the reason? The flows keep coming. The flows, if you remember the SIP book, right? I've said this on previous shows, is actually around 50 to 60% tilted towards mid and small cap. So one of the reasons that you saw today that the large cap index correcting more than the mid and small cap, which is very, very unusual, is because fund managers are sitting on cash which can truly be deployed in mid and small cap and not so much in large cap because of the composition of the flows, right? You have thematic funds, mid cap funds, small cap funds. They are the ones dominating the SIP flows. So I think that what's happening is that you have this thing, there's an Alfred Tennyson poem there, right? Water, water everywhere, not a drop to drink. So what it means is when the FIs are selling, even if domestic fund managers would like to step in and buy, the money they have from the investor is in mid cap and small cap funds. And SEBI is very strict about how you can deploy those. So I think what we are seeing is there is money in the system. fund managers are not buying all the large caps which the FIs are selling because A, they don't have enough of that, and B, look at it from a domestic fund manager's perspective, right? We have a bad GDP growth which was predicted by the earnings season. Now we are having a RBI governor say there's going to be a 1.4% uptick in GDP growth. You're seeing some of the festival season numbers indicating that, but they would be foolish to go and deploy based on that anticipation. It's a matter of January 10th, right? When the result season starts flowing. So the sensible thing to do is sit with cash, wait for the results, quarterly results, see whether the festival season play out is showing up in the numbers. Second, see what all these analysts and everybody is saying about the future, the guidance which comes from that. And the third thing why domestic fund managers are, I would say, still sitting a lot of cash is that the budget is probably one of the most anticipated, because this year we've seen that unusually the government has not spent its budgeted amount on capex. There's a huge catch up they have to do in the next 6 months. Are they going to do? And if they don't do that, then what are next year's capex projections like? So these are all the multiple factors that are weighing in. So I don't think that the domestic finance are going to rush. They're buying good quality mid and small caps because those are related not to the liquidity from the FIIs, but to the earnings growth prospect of these companies domestically. So rather they're putting their money where there is visibility and they can see the earnings growth. But where the FIIs are playing, which is in the large cap and large mid cap space, they'd rather wait and watch. And so when an FI is selling, they're actually allowing it to correct. Because from his perspective, he's deploying from a 3 to 5 year perspective. The cheaper he gets a good quality stock, the better. So why do I rush in to buy? Right? They say no fools rush in where angels fear to tread. So I think it's just being smart investing behavior by domestic fund managers at this point in time, waiting and watching, seeing what happens. And naturally, the domestic fund managers also did not anticipate the depth of the Fed related inflation and growth prospects, right? They were also taken by a surprise. So if everybody just wait and watch, holiday season, sit back, sit on the sidelines, volumes will be thin, trading volumes will be thin, but come January, from 10th onwards, I see both an FII return and domestic fund managers gradually starting to deploy in those sectors where they see a good guidance for the coming year.
Right.
Right, if you sit on cash right now and you said that you look for quality mid caps, where would you look for these opportunities now? Clearly, Santa is missing in action. You said sit back and relax. Although if you look at red on the screen, it's difficult to sit back and relax, so to say. But if somebody has to look for smart opportunities within the mid and small cap basket, where do they look for it? Is there any pocket that you would say, maybe look at defense names, because, we have the budget coming up in 2 months and you will have a full capex outlay there as well. So in anticipation, should you look at these opportunities now?
See, defense definitely is starting to attract because of the depth of the correction which happened, right? And you're right that the budget could give a fillip to the defense part. And I think defense is also positive for one more reason. I think the whole Trump tariff picture, right, he's going to bargain a lot. So I think India might end up spending some more on defense related to US buying, so that we can counter the tariff that he's going to put on imports from India. So I think defense is a good story, and the correction, I think, augurs well. But I would say more important than that is you have to look at the underlying themes in the economy. And I think what's happening is that one is on the consumption, the trend, right, with quick commerce and with all these new age kind of things happening, the tech impact of it, the AI impact. I think those are the sustainable stories for the coming year. That's one. The second aspect, which is very, very crucial at this point, I would say, is that the per capita GDP, for all you say the GDP numbers were not great, it's the fact that per capita GDP of India has moved from 2,200 of just a few years to 2,800. And that's what has caused. And there's a disparity in that income trend. So this K-shaped recovery, right, I would say that it's still sustained, because at the bottom end, the high inflation is hurting the retail consumer. But the HNI, you saw that news item about 100 crore properties selling like hotcakes. So clearly, I would say consumer discretionary at the higher end is still a good pick, and a lot of mid cap and small cap companies in that space, I would say, would actually deliver on the expected returns. Though the valuations are high, it's still a worthwhile call to make. That's one. The second aspect here is that I think the Fed action means that the dollar is going to probably remain stronger for longer, right? He talked about rates being higher for longer. It's going to imply that dollar remains. So I would still say that IT, though today it reacted, right? IT still remains a good bet on a strong dollar scenario, Because the other thing that the Fed thing is about the US economy growing strongly, which is good news for IT demand. So I would say that today's IT correction is a temporary phenomenon. I continue to believe that a strong dollar with a good economic recovery is positive for export-oriented sectors like IT. So if you ask me, a consumer discretionary space and this, and if that K-shaped recovery switches into a broader based consumption recovery, then is when I would look at a more FMCG, lower basket, and then maybe look at capacity utilization building up and capex happening. So that's a secondary story happening, but these would be my primary areas of focus at this time.
Right. Sunil, these days a whole lot of corporates or, if when you read the newspapers, things appear that urban consumption is slowing, rural will pick up. The finance minister herself said that probably from January we could see the government capex pick up. The blip in the first half of GDP numbers was slightly seasonal. Second half could see pick up, but second half is already, half done. In a scenario wherein we see, Q3 earnings also getting washed out, or the December quarter, being slower than anticipated, do you think a market will react or probably look at cues like, what Donald Trump does or what the finance minister does on 1st of February? Because as you're mentioning, the luxury part of the, urban consumption is doing well, but urban consumption is totality not doing well. With reservoir levels at multi-year highs, rural will pick up. All these are stories we hear, but probably in the lens of the fund manager, how would you look at this scenario?
And you hit the nail on the head. I think the government has to deliver. See, one of the things with the market and domestic fund managers I've been disappointed with is that RBI didn't read the slowdown in GDP growth. The previous RBI policy, not this one, he stuck to 7.2. And then that 5.4 number came in, and then he revised it to 7.2 to 6.6. So to some extent, if the government spending is slowing down, should not RBI have been aware of that? And they can proactively say that we are seeing a slowing GDP growth, but that's temporary. No, they still stuck to 7.2. So the market was very confused and said, what is this? The RBI governor is sticking to his growth, but the numbers came out and didn't rely. So I think domestic fund managers would rather now wait to see the proof of the pudding. They would rather actually see the numbers come up. Now again, the RBI governor, as I said, has notched up the GDP expectation for this quarter from 5.4 last quarter to 6.8. But the credibility of that fact, unless the government is actually going to do that spending, and I think the economic survey which comes out a day before the budget is an important document to wait for. So I would say that at this point of time, you rather wait for the data to prove these things rather than rely on an FM or a RBI governor saying things will look up. I think market at this stage would rather keep quiet, not buy based on the rumor and sell on the fact. The normal mantra for the market is buy on the rumor, sell on the fact. But I would say there's still this expectation. See, it's a huge task for the government to pick up on the capex. And I think the probability that they will actually end up spending what they budgeted on capex for this year is looking very, very difficult. So I think we'll have to wait and see what the finance minister says about the revised estimates for the current year. Are they going to say we intended to spend 11 lakh crores on capex, but you ended up spending only 9, but next year we'll push it back? So I think there's a lot of granularity that needs to go into. So today, just based on statements by the ministry and the RBI governor, the market, I think, is not yet ready to place their money where these things are. I think now it's a question of let me see those numbers and then act. That's why I said there's cash and that's sitting on the sidelines at this point in time.
Right, Sunil, just want to get in your thoughts on this hot quick commerce space as well, right? Day in and day out, we see some of these brokerages coming out with notes on Swiggy as to how it's, available at a discount to market leader Zomato, and the runway for growth is huge. First of all, it has to play catch up with Zomato, and then, of course, its own growth runway. But, recently there was a report by Macquarie also where they said that the unit economics, for these companies are unsustainable, and valuations wise, they are, way ahead. Your own thoughts, when you look at a bottoms up approach to stock picking, would you advise taking a bet on these stocks?
My suggestion there is that this is a race to disaster in terms of the pricing. So it means that some players will have to drop out, and so this is the time when the deep pockets will come to play. Now, whose deep pocket it's going to sustain is very hard to say. So I would say that the overall space is going to expand, right? But who's going to be the winner is going to be very difficult to predict. So the best way to approach the space is to diversify by a little bit of every one of these companies, and one of them will turn out winner, and the winner takes all is the typical scenario here. But it's very hard at the ground level to say who's going to be that winner. So I'd rather not go and choose X stock over Y stock, X company or Y company, and say you'll be the winner. No, rather you buy everybody so that the space is going to expand. So you will ultimately not make as much money as buying the right winner, but at least you will end up making money of the overall pack expanding. I don't think all of these players are going to survive and sustain. It is going to be, I don't want to use a word like bloodbath, that's too strong a word, but definitely this kind of lost leadership to gain market share and gain that business, it has to quickly result in some companies dying or getting acquired, and then a few players then dominating this space. So the best way to play it is diversify.
All right, that's the view. Fair point. Then, with that, Sunil, we've come to the end of the show. Would like to thank you for taking out time and joining in this afternoon and sharing your thoughts. I look forward to another conversation with you on the morning show sometime soon.
Sure, happy to respond to that. Just ask for somebody to reach out. Okay.
All right.
So, thanks a lot.
Sure. We'll do that. Thanks a lot. Thank you. Well, with that, Yatin, Santa clearly is missing. Yeah. I
Yeah.
mean, we have Christmas,